warned that storm clouds were gathering over the global economy and that governments and central banks might not be well equipped to cope. We'll find out how the global investment landscape is shaping up, as well as focus on Africa as an investment destination with Jonas David. He's a strategist at UBS Global Wealth Management. Jonas, thank you so much. It's a pleasure to have you today.
Thanks for having me here.
So very little disturbing comment from the International Monetary Fund saying that the major headwinds ahead from 2019, and it fears that governments and central banks may not be well equipped to deal with those headwinds. But what is your perspective?
Yeah, we watch these developments also very closely, as you can imagine, and indeed, growth globally is expected to slow down in 2019. We expect growth of 3.6% compared to 3.8% this year, for instance. What does it show us? A softening of growth, but not a major slowdown. The critical question that you already hinted on is, are policymakers equipped if we see a stronger than expected slowdown? And in this context, I think it's worth keeping an eye on the upcoming central bank meetings in Europe and also in the US to see how policymakers communicate about the outlook and provide forward guidance to markets on next policy steps.
Now, for the US Fed meeting next week, general consensus is that there's going to be a hike in rates. The market expects it. I mean, that's what analysts are saying. But what are you saying? Is it a likely event?
Yeah, that's also still our base case, that the US Fed will increase the policy rate by another 25 basis points next week. And the reason here is that the economy is still very strong, right? We see low unemployment rate, gradually but contained inflationary pressure, and the growth dynamics are strong. And in this environment, another rate hike is justified, but as indicated earlier, the critical dimension is what's the outlook in terms of policy measures next year.
Okay. Now, if that does happen, because there's been a lot of talk about if that happens, we might see, of course, a reallocation of assets, fund managers looking for where they're going to get the best return on investment, emerging markets always on the radar. Sometimes frontier markets too, like Nigeria, or emerging market like South Africa. But what do you see, how do you see the scenario playing out if that does happen?
Yeah, that's a good question. And I mean, when we have a quick look at what happened this year, right? I mean, the pressure in countries like Argentina and Turkey showed that markets that run significant external imbalances are exposed to these tighter liquidity conditions globally. On the other hand, investors are also very well aware that not all emerging markets or all frontier markets are the same, right? It's a pretty diverse group of countries. And those that actually implemented economic reforms over the past years and fostered improvements in their growth outlook were actually quite resilient. And these are also the segments that we would focus on. So more defensive markets in this environment instead of the risky positions that could quickly come under further pressure if global conditions deteriorate.
Now, also remember that the ECB, I'm not sure we mentioned that the ECB too is going to meet next, was that tomorrow?
Tomorrow, yes.
Tomorrow.
Yeah.
And also next year, the quantitative easing is going to end.
Yes.
Just a quick note on that. What kind of impact should we expect?
So from a global perspective, the US Fed is the dominant driver when we look at capital flows to emerging markets. The ECB is also important, and the quantitative easing program will likely end. And the question is then, what happens afterwards, right? Will there be a hike in the policy rate? I think in the foreseeable future, that's rather unlikely because growth actually softened quite a bit over the past months, especially in countries like Germany. And there are a lot of political uncertainties around, right? I mean, Italy is one of them. The situation with the UK,
the Brexit,
the Brexit.
Still no deal.
So in this very uncertain environment, I think policymakers will likely communicate a dovish message to markets and reaffirm investors that the stimulus will last in the current form in terms of the policy rate.
I'm trying to get into the head of the typical fund manager who is sitting there right now and looking across the globe, looking across markets and saying to himself, you know what, there's so much uncertainty right now. I'm probably looking for a very good haven, relative good, good haven if there is, flight to safety and all of that. So, and then he takes a look at emerging markets. Where would he be looking to go?
Yeah. So from a global perspective, so for instance, in our portfolios, we have a moderately risk-on stance. What does this mean? It means that we have an overweight position to global equities, so broadly diversified across regions, because we think growth, although softer, is still at sound levels, and earnings dynamics and valuations argue for some upside after this weakness that we saw over the past month. When we talk about emerging markets in particular, we think sovereign bonds denominated in US dollar are currently something worth looking at. For equity markets, we still think it's slightly too early on a broad basis. And the reason here is that the growth outlook is still softening. And unless we see a bottoming out of growth dynamics in emerging markets, we think a broadly diversified exposure to equities is the better way to position.
Do you think we might wait for a while? Because, I mean, just looking about the trade tension between the US and China, is still no solid deal yet. Yes, there have been talks. We had that announcement from President Trump that China has agreed to buy some agricultural products from the US, and, you know, I don't know. It appears sometimes to be neither here nor there, and I know that is creating more uncertainty for the markets. Add oil price volatility to that, although OPEC has been able to get a cut recently. But I just feel like it's just so much for the market to digest all at once. What are your thoughts?
Very valid concerns. I think what we saw earlier this year is that the market was a bit too optimistic, and now it's probably a bit too cautious, right? And everything that we see in terms of news flow is a potential setback. I think what we saw at the G20 meeting is that policymakers are not dogmatically following certain policies, but are very well aware of the impact that it has on their economies and financial markets. The temporary agreement to continue negotiations between the US and China is a positive, and we have to see how the next 3 months play out. But it's clear there's still a lot of uncertainty. But we think it's worth looking at markets where an overly bearish scenario has been priced in and value has emerged, and these exist.
Absolutely. Thank you so much, John. It's been a pleasure talking.